If you'd like to learn whether the Rock Retirement Club could be an important piece of your retirement puzzle, come hang out with me on Thursday, July 15th at 7 p.m., and I'll share a little bit about the club, answer your questions, and we can just talk about rock and retirement. Learn more at livewithroger.com. Do you want to have the confidence to truly rock retirement? Well, I'm going to show you how on the Retirement Answer Man Show. Hey there, welcome to the show. My name is Roger Whitney. This is week 2 of a month-long theme on choosing your retirement strategy. And today we're going to talk a little bit about what is characterized as the safety first strategy. Last week, we talked a little bit about the 4% rule. And then just to give you some visibility into the next few weeks, next week, we're going to talk about a hybrid of the two. And then in the last week of the month, we're going to hopefully create a framework where you can start to figure out which one makes sense for you, because it's definitely not one size fits all. In addition to that, we're going to have questions on Roth conversions, inherited IRAs, a question on the 4% rule, and one on advisors justifying their fees. He's a little upset with some of my answers, so we'll hopefully satisfy Juan. But with that, let's get on with the main segment on talking about choosing your withdrawal strategy, the safety first approach. Last week, we talked about the safe withdrawal method, which is what the 4% rule characterizes as what's a safe percentage I can take from my assets and hopefully not run out of money. And so it's very much portfolio based, where you're just simply selling or having a small contingency fund and then letting everything else ride in the markets at some level. The opposite on the spectrum of that is a style called safety first. And it has its origin mainly from the academic community. Wade Pfau from Retirement Researcher is a big proponent of this. He wrote a book on it. And the safety first method ignores safe withdrawal rates and the idea of asset allocation, and instead focuses on the fact that, hey, this is too important to have variables of what kind of return sequence we get, markets, and risk it overspending and everything else. Retirement is too important to have those variables because you get one shot at this and you only have so much money. So it's very important that you secure your income sources using various vehicles so you can eliminate sequence of return risk and moral hazard of spending too much. So the safety first approach looks at it from a very different lens. And I understand the lens that it looks at it from. And I tend to lean a little bit more this way in the sense of this is your one shot at it. So you don't want to mess it up and you don't want sequence of return to, or moral hazard of spending too much to really impair your long-term retirement. The safety first approach prioritizes your goals. And number one priority is your base needs. That needs category, it argues, is the most important focus. The ability to pay for your groceries, your housing, your healthcare, your clothing, the roof over your head, all of that stuff. That is so important that first you need to secure your income for those things using the assets that you have so you can have that comfort that they're taken care of. And then you have a contingency fund, we'll call that an emergency fund, in addition to sort of help with life shocks of unexpected medical expenses and so forth. And only after you have this contingency fund and your base needs secured through various vehicles that ignore markets and are about giving you guaranteed income sources that you can't outlive, only after you have those two things in place do you look at what assets are left over that can focus on other goals, be they your extra travel budget, your go-go years, or legacy, or what have you. So that's the essence of safety first. So it focuses a lot on very secure assets. So what do we mean by secure assets that give you an income flow? Well, a lot of this has to do with what we call on our show anyway, social capital, right? Your pensions, which some of you may have, but your Social Security, which you definitely have, unless you're opted out of it in some way. That's a good example of social capital, income that you can't outlive. And then it's typically characterized as income annuities that supplement Social Security as a foundation to secure these income sources. So how exactly would you implement a safety first withdrawal method? Well, first, what you want to do is determine your base needs for your retirement lifespan. So that would generally be an exercise of budgeting of, okay, I think I'm going to need this much for housing, this much for healthcare, groceries, and so forth. And then you forecast that over, let's say, your 20 or 30 years lifespan in retirement. And there's probably some inflation factored there. So you get an idea of how much money you're going to need every single year for those base needs. I've heard the phrase, the minimum dignity floor. And I think that's a good phrase of that's what it's trying to give you. Once you've calculated your base needs for the rest of your retirement life, so make sure you have a minimum dignity floor, then you subtract from that annual amount what you're already going to get, say, from Social Security or a pension or annuities that you may already have in place, because you already got that part in place. And then you look at the difference that needs to cover this minimum dignity floor. And then you look at how much it would cost you to go buy, whether it's bond ladders and income annuities, such as a deferred income annuity, or I guess a single premium income annuity and so forth, that would, by taking your financial capital and purchasing bond ladders or an income annuity that will give you lifetime income guaranteed, how much of your financial capital would it cost to buy those products in order to create this minimum dignity floor? And so you would take, say, $500,000 to buy you what you think you need to create this income floor. And you would take that from your portfolio, buy, in this case, say a bond ladder or an income annuity. And then whatever you have left over is going to be your contingency fund and money that really is your play money that you can use for things like travel or gifting, the more spice of life. And at the end of this exercise, taking it to the extreme, you would have guaranteed income for the rest of your life or both of your lives if you're married. And you would have money left over that you could use to secure for shocks of unexpected events or for the spice of life. But you're in a position where, hey, I have money that I can't outlive. I know I'm going to get this is truly getting a retirement paycheck, isn't it? I'm going to get my paycheck from Social Security. I'm going to get my paycheck from bonds maturing if I do a ladder, and I'm going to get my paycheck from my annuity every month for the rest of my life. Doesn't matter if I live to 120. So that is roughly the concept of safety first. Now, what is the timing of implementing something like this? So one school of thought is, well, you just implement it at retirement, right? You're turned 65, you calculate how much you need to supplement Social Security, you take your assets and you go buy the products that will do that for you. And then your life is pretty simple. You're going to get a paycheck and that's what you live off of. If you have money left over, you can use that as your emergency fund, as well as a contingency fund, and maybe you invest for future growth for other things. Another school of thought and implementation is calculate it all, but still keep it liquid and investment based. Maybe you build the bond ladder on the short end and you keep the rest of it invested. And then later in life, maybe when you're 70 or 75, then you implement this safety first approach. The logic being that early on, it gives you flexibility to figure out what you don't know and get in a rhythm in retirement before you actually commit money. In some cases, in the case of a single premium annuity or something like that, where you can't really undo those. So one school of thought is you do this later in life. Now, I'll admit a little bit of bias here. I like this approach, but it's not one that I typically use. I like thinking in terms of safety first. In terms of buying income annuities, it's not something that I do, that I have ever done. And that could be a limitation because I don't understand it well enough, but it doesn't really fit for me with being more agile and having more control and more flexibility. I tend to value flexibility a lot more. Doesn't mean that I'm right and the safety first approach is wrong. Just wanted to acknowledge that that's sort of the view that I come from. Now, what are some of the advantages of this safety first approach? Well, one is obviously there's a lot of peace of mind. You may show less money in your bank account if you purchase annuities that give you income for life, but you got income for life. You don't have to worry about the markets. Markets go down 40%, you're still getting your paycheck. If you do a systematic or safe withdrawal rate, even if that safe withdrawal rate is quote unquote still safe, it's a lot scary to see 2, 3, 4, 500,000 of your money disappear in market value. Even if it feels like a safe withdrawal rate, you probably aren't going to do it. In the safety first approach, it doesn't matter. You're getting your check. Doesn't matter what the markets are doing. Now, I saw a discussion between Wade Pfau and Michael Kitces, and they're a little bit on the opposite sides of this online. And we call this safety first, but there is still some risk in terms of the annuity companies having the ability to pay their promise to you, right? And in case the annuity company can't. So there is a little bit of risk there. And when you use bond ladders or individual bonds, there is a risk that the issuer of the bond could default. So those are outlier risks and a lot more binary. They're not ones that you see every day, but I guess that makes it sense. I got Michael's point on that. Another advantage of safety first is you have smooth income flows, and that helps you get into a normal rhythm of life. When you have, when you implement a safety first strategy, you're going to pretty much know what your income levels are going to be. And that really fits with human nature in that we're comfortable living with the monies that we get deposited into our bank account from our paycheck. So it is smooth and will help you naturally have a rhythm because you don't have to wonder how much you can spend. It just hits your bank account every month. Another is it's very easy to manage, right? Once you get all this in place, there's not much you have to think about. This might be one reason why this is really attractive, say, later in life when we're getting into our slow go and no go years, especially because we don't have to do as much. We don't have to worry about withdrawal rates. We don't have to worry about income floors or buckets or any of those other things. So that might be an argument why maybe this is a strategy you look at for later in life. So you can turn on the easy button when your spending in terms of base needs is probably a lot smoother after your go-go years. And also if the spouse managing the assets is worried about, well, what happens when the surviving spouse has to do it when I'm gone? This might smooth it out for him when he doesn't have you to manage the money. So I can see some very I get more attracted to this personally in a later stage of retirement rather than early retirement, but it definitely smooths it out and it's easy to manage. You can't outlive the income. So even if you blow all the other money, you have some guaranteed income sources, which is really nice. And then one last advantage, which is a little hard to quantify, but I think it definitely is an advantage, is if you're 63 and you implement something like this, you may have less liquid investment assets, but the investments assets you have, you're likely going to be much more comfortable in investing them more aggressively because you have all these payments coming in. You don't have to worry about whether the market goes down next year or not near as much as you would if you were doing a systematic withdrawal rate, right? Because you're not likely taking money from your investment assets. So you can actually be more aggressive or growth oriented with what you have remaining because you don't really need bonds because you don't need the stability because you've replaced that with these guaranteed income sources. So those are some big advantages to this, I think. Now, what are some of the disadvantages of the safety first? For me, as a practitioner of agile retirement management, is it creates less flexibility for people changing their mind and changing their life and circumstances. And I value flexibility. Maybe that just means I'm a control freak, but I value flexibility because I've seen, especially people that retire between 60 and 65, especially, not to say that it doesn't happen older, but people change their minds a lot. Their life transforms significantly after retirement compared to what they thought it was going to be. And maybe that's one reason why I'm attracted to a safety first as a fallback a little later in life once we've figured that out, because I think having options is really important. Another potential disadvantage is inflation risk. Social Security is adjusted for inflation, so that's a plus. Most annuities, I'm not sure if they may have one or two, but I'm not familiar with them. Most income annuities do not. So if that $50,000 a year income from, say, a single premium income annuity may be attractive today, but 20 years from now, that $50,000 may be worth half as much in terms of purchasing power. That's something you need to factor in. And if we have inflation spikes, we go into a very high inflationary period after you secure a guaranteed income source. Well, that's going to just degrade the purchasing power of that even more. And I'm not quite sure how that works out in the safety first approach because it's not something I really used. And then you have less flexibility for spending shocks or pivots. And I think using a safety first approach can ignore some rhythms of life. What do I mean by that? Well, we make decisions based on the current version of us, right? Of you. And you can do some forecasting of what you think your 70 or 80-year-old self might be doing, but you really don't know. And it ignores the rhythms of life from go to slow go to no go. It also ignores a lot of what happens in the first 10 years. And I think first 10 years of life, and it creates, I believe, potentially less flexibility. But I do think this is a very important approach for certain people today. And in our last show of this month, we're going to create a framework because I think safety first is the best option for a certain segment of people. Just like I think a safe withdrawal rate may be one of the better options for a certain segment of people because it has to do with a lot of things, which we'll get into, which is what is your fundedness ratio and personal preference and what percentage of your base needs are already covered by social capital, say Social Security and pensions. There's a lot that goes into this, but this is the essence of what a safety first approach is. So next week, we're going to get into a hybrid, which full disclosure is typically how I think and operate. So I have a little bit of bias there. But for now, let's go on to your listener questions. So I'm flying solo and answering your questions today. And at the end of the Q&A segment, I guess we'll call it the feedback booth. I have Juan on some of my, what he calls non-answers to his questions. And I also have a review from someone that sort of kind of called me to task on not talking to females and acknowledging them near enough. So we'll get to the feedback booth, but let's get to some of your listener questions first. First off, I need to do some cleanup. A week or two ago, we had a title of a show that talked about a question: how should I incorporate an inherited IRA in my retirement? And I didn't even answer that question on the show. So I apologize. I think this happened as I was in the thralls of being out of rhythm with my trip to Colorado. So I apologize for that. So the question is, how should I incorporate inherited IRAs into my retirement plan? Because they are going to be a little different, aren't they? Because when you inherit an IRA, you have these required minimum distributions that you have to do each year. So the way that I incorporate them is once you have a feasible plan and you're working on making it resilient, and the way you make it resilient, if you recall, is we build a 5-year income or cash flow model to show what income we're going to be receiving year by year, and then what spending we're going to be doing year by year, and then a basic tax estimate. So we get an understanding of the deficit that we're going to have. And that deficit is where we need to get money from our investment assets or financial assets. So the way that you incorporate an inherited IRA into this type of structure is when you're building your 5-year cash flow forecast, you're going to have as an income item the expected required minimum distribution from that inherited IRA, because you're going to have to take it out. And you can estimate that fairly easily. What I typically do is if it's worth, say, $1 million today, I calculate the RMD for this year, and then I subtract that amount from the value of the inherited IRA. I assume the IRA grows by 5%, and then I apply the life table that's used to calculate the expected required minimum distribution for the next year, and then the next year, and the next year. And that way you have that in your 5-year income forecast, and then you're able to create a guesstimate of what the tax liability will be each year. So that is how I incorporate required minimum distributions. Now, another item here with inherited IRAs, if you retire and you are not receiving any other income, and you have to make this decision, do I do Roth conversions or do I not? You could essentially also model using your RMDs from your inherited IRAs to be doing Roth conversions from your normal IRAs so you can minimize your RMDs later on. So there's a lot of planning that can be involved there. So hopefully that's helpful. Our next question comes from John on taxes and Roth conversions. John says, my brother is 67 years old. His net worth is about $2.5 million. He's single, has income of about $35,000. So he's about in the 8% effective tax rate, he says. He has roughly $900,000 in a traditional IRA, $200,000 in a Roth, and about a $1.2 million paid for house. And John is worried that his brother is going to have tax issues down the road with this huge traditional IRA. He's got nieces and nephews he'd like to leave money to someday. He doesn't have any money to pay taxes on conversions if he were to do an IRA to a Roth conversion. So it'd have to come from the Roth asset. What do you do? Is it worth doing Roth conversions in this situation? Well, the actual answer, John, is that it depends on a number of factors. And it also depends on future cash flows, tax rates, all sorts of things, right? So let's see if we can create at least a very basic framework for you to start creating some scenarios, John, to maybe help your brother. I usually start with, okay, what would be the RMD if John just let the IRA grow and didn't touch it and didn't do Roth conversions? Because then you'll have these required minimum distributions. So he said John is 67, has 900,000. If we assume that 900,000 grows at 5 or 6%, in 2025, he's going to have required minimum distributions of about $47,000. And he's single, so 47,000 plus his 35 is going to put him right at the top of the 22% tax bracket. I'm just looking at today's taxes. I know we convert or revert back in 2025. So if he does no Roth conversions, it looks like, John, that first year, he'll be at the top of the 22% tax bracket. Now, that's not really too bad. The question is, where does it go from there? So a couple strategies, John, that you might consider modeling with your brother is, since he earns $35,000 a year today, which puts him, a very low tax bracket, maybe he starts doing partial Roth conversions to the top of the 22% bracket or even the 24% bracket. And that top bracket, the 24% bracket as of this year, is about $164,000. So he could start doing partial Roth conversions, paying the tax from the traditional IRA, and feel comfortable that, hey, I'm going to be paying 22 or 24% taxes, and then have that money as the money that can grow long-term for his nieces and nephews. He could also begin to just take out money and fill up these tax brackets and just invest it after tax. But I think the Roth is probably the better option. So if you did something like that, John, you could convert roughly $130,000 per year for the next 4 or 5 years and get a substantial portion out of the traditional IRAs. Now, what this will do is give your brother, he'll still have money in a traditional IRA and he'll have to do required minimum distributions. And then he can use that to supplement his income and his Social Security and have Roth assets that can grow long term. Our next question comes from Dave on last week's episode about the 4% rule. Hey, Roger, I just started listening to your show. I'm enjoying it very much. Here's my question. You talk about the 4% rule recently. Does this also take into consideration the money that you would be receiving from Social Security or an annuity or pension? Or is the 4% simply out of your investments and assets? It would seem that if you have an income stream coming in, the 4% could be played out. In any case, keep up the great work. So Dave, when we talk about the 4% rule, we're simply talking about the amount of money that you're taking from your investment assets. So it doesn't incorporate pensions, annuities, Social Security, et cetera. And from the original study, it was simply trying to determine how much could we take from our assets, inflation adjusted year by year, without depleting all of the assets. So all these things, which we call social capital that you mentioned, are a totally separate issue. So hopefully that clarifies it for you. Our next question comes from Allison on how bonds work. Allison's question is about bonds that she received from her grandmother. So she says, I understand the coupon rate and maturity date, but otherwise it's a little confusing. My account shows current balance, price, and quantity, but the quantity and price don't match up with the current balance. Can you help me understand that? Also, when I receive my coupon payment, can I reinvest it back into the bond like I do with stocks? Well, that's a great question, Allison. It's hard to see what you're looking at to really identify the incongruence between what you're seeing and the current price and quantity. So let's approach this. On your statement, you're going to show I have XYZ bond and I have 50 of them. And the current price of those 50 bonds is 105. Because usually they'll show it as like 105.00 or something like that. Well, the first thing to understand, and this is a quirky financial inside baseball thing, is that 105 that you may see on the statement actually means $1,050. So you would look at the number of bonds times, you'd move the decimal over once to the right. And then that times the quantity would show the current value of the bond. So I don't know if that's what you're looking at, which is confusing. And then in the account, you'll have probably cash and everything else. But I think if you make that little adjustment, it should all add up. Now, a quick statement on that. When you have 50 bonds at maturity, those will mature at $100 or $1,000 per bond. That value that you see on a statement is pretty worthless. It's just an indication. Last I looked, there were like 2 pricing services that all these brokerage firms use. And because bonds don't trade on an exchange like stocks, at least most don't, the price is really just a guess based off of the last trade that might have happened a month ago. So don't put too much stock in the price that a bond represents on your statement. So that might be the incongruence, Allison. And if that's not what you were saying here, shoot me a screenshot and just email me at roger@rogerwhitney.com and I'll look at it. Maybe I'll understand what you're looking at. But usually it's that quantity times price. The price isn't going to be represented. You'll have to move the decimal over once to the right. Now, your second question is about coupon payments. Can they be reinvested back in the bond? And the answer is no, they can't. Those are just interest payments that you are going to receive. So it doesn't work like a stock, because when a bond is issued, say XYZ company issues $1 billion worth of bonds, once it's issued, it's issued. There aren't any other bonds available unless you go buy them on the open market. So you can't reinvest those like you can a stock. This is one advantage of, say, a bond mutual fund. There are other disadvantages too, but a bond mutual fund, you can keep reinvesting, and what they essentially do is just go take the money and buy more bonds. One little interesting tidbit, a lot of times we buy bonds on, okay, I'm going to buy this bond, this is the coupon rate, and this is my yield to maturity. That yield to maturity, which we all key on when we buy an individual bond, actually assumes you are reinvesting the dividend. So it's really overstated. So Allison, if I didn't answer your question clearly, just shoot me maybe a screenshot of an example and I'll try to answer it for you. Our next question comes from Todd on the infamous pro-rata rule with Roth IRAs. He says he's a new listener to the show and he loves it. Good, Todd. Hopefully we won't disappoint. I had a question about the pro-rata rule. It seems to have come up a lot, so I thought I'd ask. Our 401k plan advisor said it didn't apply in this situation. So this is his situation. In our 401k plan at work, we have the option of contributing to the plan traditionally or as a Roth. There are several employees that do it 50-50 between each. It is my understanding that even though we can see how much is in each bucket or basket, Roth contributions, pre-tax contributions. Withdrawals will have to follow the pro-rata rule, aka the cream in the coffee. Is it different because it's a 401k and not an IRA? Hey, Todd, it really is different because you really aren't mixing those assets together like the cream in the coffee analogy you referenced. So when you have a 401k, you are making a contribution to a Roth bucket and a contribution to a pre-tax bucket. And those are separated. So as an example, Todd, when you retire, and let's assume you want to roll those to IRAs, the Roth portion would go to a Roth IRA and the pre-tax portion would go to a traditional IRA. So they're actually in separate cups, even though they show on one statement for you. So as an example, let's just say you decided I'm going to do 100% of my contributions to the Roth bucket. This is what I do in my company. So you're going to contribute 100 of your employee contribution to the Roth bucket. If you have an employer that matches your contributions, that is still going to go in the pre-tax bucket, not the Roth bucket. So the pro-rata rule doesn't apply in this situation, and hopefully that helped clear it up. And with that, let's go set a SMART sprint.
On your marks, get set.
And we're off to set this baby sprint we can take in the next 7 days, not just rock life, but rock retirement. So over the next 7 days, if you already have done some financial planning, why don't you do a basic calculation of how much of your base needs in life are going to be covered by Social Security, pensions, and annuity payments? So get an idea. Is it 0%? Is it 70 or 80% that you're going to have covered by these guaranteed income sources? That's a good number to know so you can understand the stability you have in your income flows. And then you can use that number later on when you're making other decisions. Well, welcome to the feedback booth, where we address some of the feedback that I received from listeners. Now, recently, I gave a presentation at the main library in Arlington, Texas on podcasting. We had about 10 people there or so. It was a blast. Hadn't done something like that in a while. And so I had to create a presentation to aspiring podcasters or people that were podcasting. And one of my pearls of wisdom was the show isn't about you, meaning the host. The show isn't about the host. Although initially, when you are thinking of doing a podcast, when you start a podcast, a lot of the reason you do it is because I got this to say. I want my voice to be heard. That's usually the spark. But in my opinion, really good shows are all about you, the listener. My job as a host is to serve you and talk about things you care about. It's not about what I have to say. It's about helping you improve, in this case, your life and hopefully rocking retirement. And so I think feedback is really important. Now, I'm going to create a show that I like, but it has to be about you ultimately. So we got a couple pieces of feedback I thought would be fun to address so we can continue to make this show better for you. So the first one is actually an iTunes review, and I'm going to call her Mag. And the title of the review is Women Make Financial Decisions Too. Now, it was a 4-star review, so Mag was kind to me on the review end, even though she had some feedback. Great content. Roger, you do a pretty good job of creating equality between men and women. However, you invite many guests that talk about men and husbands that are in charge or leaders of the financial decisions. This may have been the case 70 years ago, she says, but I am a wife, majority breadwinner, and partner with my husband on how we spend, save, and invest. I will continue to listen, but skip podcasts that mention that men run the finances in the household. Well, I'm glad that you feel I do a pretty good job of not falling into that category. The category of always assuming it's the man, the husband in this case, that makes the financial decisions is an issue that our industry has had for decades. It has grown up as a male-dominated industry, and it does. And I've seen it. I've talked to clients and others that have had this experience where in this case, the wife, with a married couple, is dismissed in the financial decision making, either because they feel, well, you have your husband to take care of those things, or you don't understand this complicated stuff. So I do think that is definitely an issue in our industry. I think it is changing rapidly, and I'll be aware of that with guests. My guess is that they don't do it intentionally, but I can understand your point. So we'll be mindful of that. Thanks, Mag. Now, our second bit of feedback comes from Juan, and Juan is not happy with me. So Juan asked a question a number of months ago about financial planner fees that I attempted to answer on the show, and he felt I struck out horribly. And then he mentioned that Brian had asked the question that I answered on the show, and he thanks you, Brian, for bringing it up again. But whoa, Juan thought I sidestepped the actual question again. In fact, I think the image that he wrote in his email was there was this big fire and Roger did everything he could to dance around the subject, so it made it look like he was hiding something. So Juan, we're going to give it one more swing, and if I strike out, I'm sorry. So here's the question that Juan had, and I'm paraphrasing because he wrote a long email. He says, financial planners that use the assets under management fee model, which is the prevalent model in our industry. And that essentially means that we charge a percentage on the assets that we're in control of. How does a planner justify earning twice as much on a client with $800,000 compared to a client that has $400,000? Even if the $400,000 client may have a more complicated life and take up more time. How do you justify that? That is a reasonable question, Juan. I have a question about the premise, but before I get to that, I'm not going to try to justify it because I don't speak for the industry. I can only speak to how I operate. And there is definitely a lot about the industry that I don't agree with. The male domination and how they focus and dismiss ladies sometimes, how fees are charged, what people actually do for the fees. I have issues with a lot of these things. So I'm not necessarily in disagreement with you, Juan. I can only talk about some observations of how that is and why maybe it's not right. And then also how I do things. That's really the only way I can address this, Juan. First off, I think the premise that they're going to automatically charge twice as much if the assets are higher, I think that actually is not typically the case. Usually with this type of model, as the asset level of the client goes up, the percentage of fees go down. So it's scaled. So the more assets, as a percentage, the fees go down as you get more assets. So it's not as clear as twice as much. And I think a business person, and also from a service level, advisors that serve a wide swath of clients generally will have different tiers of service for clients. They'll have a certain level of service for the $400,000 client, then a higher level of service for the $800,000 and so forth. Personally, I don't operate that way. Every client gets the same level of service. Some do take more time than others. It's hard to know who they are. And I don't work with a wide swath of assets, meaning that most of my clients have roughly the same, within a range, the same level of assets. So I don't have these big swings as you talk about. And although I work on an asset under management structure, my fees are generally lower than average and they scale down. They go down as the assets go up much quicker than others. But I get your point, Juan. And I think as a consumer, there are lots of products that don't make any sense in terms of how they charged. And they don't make sense to you, but they make sense to somebody else. And I think that's your choice. And I think it's really important. And one thing I challenge those that consume financial advice is to have open conversations about what kind of value are you giving me for my fees? Let's talk about that openly so I can feel comfortable that it's a win-win for both parties. So I think that's totally reasonable, Juan. So I don't know if there is a justification for the way that you frame it. I do think a good advisor will, one, tier fees down as the assets go up, as well as put service levels based on different fees. So they're not getting their time dominated by, in this case, lower revenue clients. That's not good business. Not good business for the clients, not good business for the advisor. Where that assets under management structure came from, really it came from the investment management industry because advisors, financial planners used to be stockbrokers or insurance salespeople. and they took the structure of the mutual fund and investment management industry and applied it to serving clients and delivering investment management and advice. So I think that's the legacy of it, Juan. Interestingly, if you look at mutual funds, whether it's the Vanguard S&P 500 or name your mutual fund, they actually have flat pricing. They charge a percentage of fees based on the assets. And the client that has $3,000 is probably taking up more time than the client that has $3 million. And the client that has $3 million isn't getting any break on the fees and for having so much more assets. So you can make that same argument is probably a lot more true for investment management when it comes to mutual funds than advisors. But the key is you got to have value for what you're paying. So I appreciate it, Juan. Don't know if you're going to be happy with my answer, but there it is. If I struck out, sorry, buddy. So glad to spend this time with you. So glad that you're willing to give me honest feedback and poke me when you think I made a mistake. I appreciate that. And I hope you have a wonderful day. Hey, it's time for that all-important disclaimer. We so appreciate you listening to the show and love your questions and love the teaching that we're able to provide here. And actually, it helps us too. But remember, you're not our clients.
Not love it if you took advice from us on the show.
We would not love it if you took advice from us on the show. Realize this is helpful in education. Talk to your legal advisor, your tax advisor, or your financial advisor before you make any decisions.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.